January 4th, 2026. Silver is around $73 per ounce. But here's what should have your attention. Two significant forces are converging right now that could determine whether silver consolidates at these levels or faces serious technical pressure in the next 2 weeks. The Chicago Mercantile Exchange raised silver margin requirements for the second time in 1 week. According to CME Advisory number 25393 issued December 26th, maintenance margins on March 2026 silver contracts increased from approximately $22,000 to $25,000 per 5,000 ounce contract. Then on December 30th, they raised them again to approximately $32,500 for initial margin, a roughly 50% increase in just 1 week. But that's only half the story. Starting next Thursday, January 9th, the Bloomberg Commodity Index begins its 5-day rebalancing period. And according to Daniel Gawley, senior commodity strategist at TD Securities, passive funds tracking this index will be forced to sell approximately 13% of aggregate open interest in COMEX silver markets over the coming 2 weeks. Let me show you exactly what's happening, why these two events together create unusual technical pressure, and what the actual data suggests about what comes next. Because understanding the mechanics here isn't about predicting disaster. It's about recognizing how markets function under structural stress. First, let's establish the facts about silver's 2025 performance. According to multiple financial sources, silver surged approximately 148% to 162% during 2025, depending on which measurement period you use. The metal hit an intraday peak of $84.01 per ounce on December 29th, 2025. That's not speculation, that's verified price data. By December 31st, silver had pulled back to around $72, a decline of roughly 14% in just 48 hours. Why did that happen? The CME margin hikes played a significant role. When exchanges raise margin requirements, they're responding to volatility. According to the CME's own methodology, margins are calculated based on market volatility to ensure adequate collateral coverage. Silver's recent price swings, including single-day moves of $20 per ounce on a 5,000-ounce contract, translated to nearly $20,000 in exposure changes. That kind of volatility forces exchanges to act. Here's the mechanism. Margin requirements determine how much cash traders must post to hold futures positions. When margins increase from $22,000 to $32,500, traders face a choice. Either post an additional $2,500 in cash or liquidate part or all of their position. For leveraged speculators sitting on large unrealized gains from silver's 150% rally, many chose to take profits rather than tie up more capital. According to data from mining.com, micro silver futures volume surged 127% in December compared to the January through November average. That tells you retail traders piled into smaller contracts trying to catch the rally. These are typically the most leveraged positions and the first to liquidate when margin requirements spike. The selling pressure was immediate. Silver fell as much as 9.9% on Wednesday, December 31st, according to Bloomberg reporting. That's mechanical forced liquidation, not a fundamental change in supply-demand dynamics. Now here's where it gets more complex. The Bloomberg Commodity Index is tracked by approximately $109 billion in assets as of October 2025, according to Bloomberg Index Services. This index rebalances annually based on liquidity and production data. Silver I's weight in the index rose from approximately 4% target weight at the start of 2025 to 9% by year-end because of the metal ES massive price appreciation. The index must rebalance back to target weights. According to Bloomberg's announcement of 2026 target weights, silver's target is just under 4%. That means passive funds tracking the index must sell more than $5 billion in silver futures holdings during the 5-day roll period that begins January 9th and runs through January 14th. TD Securities estimates this represents approximately 13% of aggregate open interest in COMEX silver markets. JP Morgan's December 12th commodities report estimated the selling at approximately 9% of total open interest, though that was calculated before the late December spike to $84. The updated estimates from TD now suggest 13%. Let's be clear about what this means. This isn't selling based on bearish fundamentals. This is mechanical rebalancing required by index rules. Passive funds don't have discretion. They must execute during the roll window, and everyone in the market knows exactly when that window opens. January 9th, 6 days from today. Here's why the timing matters. The margin hikes happen December 26th and December 30th. The index rebalancing starts January 9th. These two events create overlapping waves of selling pressure. First wave, margin-driven liquidation from leveraged longs who can't or won't post additional capital. Second wave, forced index selling from passive institutional money that must rebalance regardless of price. Both waves hit during a period when trading volumes are typically lighter. Post-holiday trading sessions often see reduced participation. Fewer market makers, thinner order books, wider bid-ask spreads. When forced selling meets reduced liquidity, price moves can be exaggerated in both directions. There's also a tax dynamic at play. According to analysis from multiple commodity strategists, investors holding large unrealized gains faced a decision in late December. Sell before December 31st and pay short-term capital gains at ordinary income rates, or hold into 2026 and potentially qualify for long-term capital gains treatment if positions have been held over a year. Many held, pushing some profit-taking into early January. This means we could see additional selling pressure from January 2nd through January 8th, right before the index roll begins. That's a third potential wave of technical selling, all compressed into a narrow time frame. Now, does this mean silver is guaranteed to crash? No. Let me show you why making absolute predictions here would be intellectually dishonest. The fundamental case for silver remains structurally supportive. Industrial demand hit record levels in 2025. According to industry estimates, solar panel production alone consumed approximately 290 million ounces of silver. Electric vehicles, 5G infrastructure, data centers, all silver-intensive applications. The Silver Institute projects industrial demand could grow to 450 million ounces by 2030. Supply hasn't kept pace. Mine production has reportedly declined about 7% since 2016. Recycling isn't filling the gap. Multiple sources cite a structural deficit where more silver is consumed than produced, persisting for approximately 7 consecutive years. And here's something critical that's happening right now. On January 1st, 2026, China implemented new export licensing requirements for critical minerals, including silver. According to reports from multiple sources, China controls approximately 60% to 70% of global refined silver supply through processing and downstream manufacturing. The new licensing system doesn't ban exports, but it restricts which companies can export and how much. This is about control, not elimination. And when the world's largest processor restricts supply, it creates premium divergence between physical and paper markets. This is already visible. According to reports, physical silver in Shanghai and Dubai has been trading at premiums of 5 to 8 above COMEX futures prices. During the December volatility, that spread reportedly hit 10. Physical buyers in Asia are paying significant premiums because they can't easily get metal at paper prices. So here's the paradox. COMEX silver futures could fall due to margin hikes and index rebalancing, mechanical technical selling. But physical silver continues trading at premiums because industrial buyers and Asian purchasers need actual metal and can't easily substitute. This creates what some analysts call a paper-physical divergence. The futures market, dominated by leveraged speculation and index funds, faces downward pressure. The physical market, driven by industrial demand and strategic buying, holds relatively firm or even strengthens. For investors trying to understand what this means, the answer depends on what you're holding and your time horizon. If you're holding leveraged futures positions, you're exposed to forced liquidation risk. The margin hikes and index rebalancing could overwhelm your position regardless of long-term fundamentals. A 13% decline from current levels of $73 takes silver to approximately $63.50. If you're margined at $32,500 per contract, the $9.50 decline represents a $9,500 loss per 1,000-ounce contract, nearly 30% of your margin. If you're holding physical silver or unlevered positions in mining equities, the equation is different. You don't face margin calls. Your risk is opportunity cost if silver remains under pressure for an extended period. But given the structural supply deficit and China's export restrictions, many analysts believe any significant decline creates buying opportunities rather than signals of fundamental deterioration. Historical precedent provides some guidance here, though past performance obviously doesn't guarantee future results. In 2011, when silver hit $49 per ounce, the CME raised margins 5 times in 8 days. Silver crashed 30% in 2 weeks. But it bottomed at $26 and rallied back to $35 within 6 months. The forced liquidation created oversold conditions that attracted buyers once the technical selling exhausted itself. In 1980, when the Hunt brothers drove silver to $50, margin rule changes forced liquidation, and silver fell 50% in 3 months. But that was a different situation involving concentrated speculation and market manipulation. The current setup involves index rebalancing, which is mechanical and time-bound, not open-ended liquidation. The question market participants are asking is this: can physical demand absorb the index selling? If industrial buyers and Asian purchasers step in at $70, $68, $65, they create a floor. The technical selling completes by mid-January and silver stabilizes. That's the constructive scenario. The bearish scenario is that forced selling triggers algorithmic liquidation and stop-loss orders, creating a cascade that takes silver below $60 before finding support. At that point, you'd be looking at a roughly 30% correction from the December peak, which would erase a significant portion of 2025's gains. The bullish scenario, and this seems less likely in the immediate term given the mechanical selling pressure, is that physical buyers are aggressive enough to absorb both the margin-driven liquidation and the index rebalancing without significant price decline. Silver holds $70 or higher, and once the technical overhang clears, the structural deficit drives prices higher in late January. Which outcome do we get? That depends largely on what happens between now and January 9th. If silver can hold above $70 through January 8th, it suggests physical demand is strong enough to absorb the coming index selling. If silver continues declining before the roll period even starts, it indicates the market is front-running the rebalancing, and the actual selling during January 9th through 14th could push prices lower still. One thing worth noting is that central banks have been accumulating gold at record rates, over 1,000 tons annually for the past 3 years, according to World Gold Council data. Some countries are also building silver reserves as part of strategic diversification. When sovereign entities buy, they typically hold for decades, not trading cycles. That provides a long-term bid that doesn't disappear during technical pullbacks. The solar industry also provides a fundamental floor. Industry analysts estimate break-even costs for silver and solar production around $134 per ounce. That means solar manufacturers can economically pay up to $134 before losing money on panels. Silver at $73, even after falling to $60 or $60, remains well below that break-even. Industrial demand at these levels should persist. Let me address something important here. Some commentary surrounding these events uses language like manipulation or coordinated attack. I think that's intellectually lazy. Exchanges raise margins to protect clearinghouse integrity when volatility spikes. That's risk management, not conspiracy. Index funds rebalance according to published rules that have existed for years. That's mechanical execution, not manipulation. Could the timing be better? Sure. Hitting margin hikes and index rebalancing simultaneously during light post-holiday trading creates maximum pressure. But that's how calendars work sometimes. December 31st is year-end. January is when annual rebalancing occurs. It's not a secret plot. It's just unfortunate timing for bulls. What should you take away from all this? If you're sitting in leveraged futures, understand your exposure. A 13% decline represents significant loss against margin. You need to decide if you can handle additional drawdown or if taking profits now makes more sense. There's no shame in that. Markets are designed to shake out weak hands, and leverage amplifies every move. If you're in physical or unlevered positions, volatility is part of the equation. The next 2 weeks could be choppy. Watching unrealized gains evaporate isn't fun, but it's the price of admission to markets. The question is whether you believe in the long-term structural case. If you do, technical corrections driven by forced selling are noise. If you don't, this might be an opportunity to reduce exposure. If you're sitting in cash waiting to enter, the index rebalancing creates a potential window. Not guaranteed, but possible. If silver declines towards $65 or $60 during the January 9th through 14th period, you're buying into mechanical selling, not fundamental weakness. That's how intelligent capital positions itself, buying when others are forced to sell. One final thought about market structure. The CME margin increase to $32,500 per contract represents an approximate 17% margin requirement relative to notional value at current prices. That's higher than the 10% peak during the 2011 crash. Higher margins mean less leverage. Less leverage means fewer weak hands. That makes the market more stable after the forced selling completes. The exchange is essentially saying we want this market cleaner. Less retail speculation, more institutional capital, better capitalized participants. That's painful in the short term as margin traders get flushed, but it's constructive longer term because it reduces the risk of a disorderly squeeze that breaks the clearinghouse. There's also the reality that open interest in COMEX silver futures represents a multiple of physical silver in registered vaults. Various estimates put this ratio between 100.1 and 350.1, meaning there are far more paper claims than actual deliverable metal. The margin hikes and forced selling help reduce this imbalance by pushing out leveraged longs who never intended to take delivery. This serves the exchange's interest because it reduces the risk of a delivery squeeze where long holders demand physical metal that doesn't exist in sufficient quantity. Whether you view that as price suppression or prudent risk management depends on your perspective, but the mechanism is the same. Reduce leverage, reduce exposure, reduce systemic risk. Where does this leave us on January 3rd, 2026? Silver at approximately $73 per ounce, down roughly 13% from the December 29th peak of $84. Index rebalancing starts in 6 days. Forced selling of approximately 13% of open interest over the following 5 trading days. Margin requirements at elevated levels. Physical premiums in Asia still elevated. Industrial demand metrics still robust. Supply deficit still persistent. China export licensing now in effect. The paper market faces mechanical technical pressure from two simultaneous sources: margin liquidation and index rebalancing. The physical market shows signs of tightness through elevated premiums and strong industrial offtake. One of these will dominate over the next 2 weeks. Either forced selling overwhelms physical demand and silver tests $60 or below, creating a deeper correction that takes time to recover from. Or physical buyers absorb the technical selling and silver stabilizes in the $65 to $72 range, setting up for a potential recovery in late January once the index rebalancing completes. The next 11 days, from today through January 14th, when the index roll period ends, will clarify which outcome we get. Until then, volatility is the only certainty. The only position that's truly safe is one sized appropriately to your risk tolerance, one you can hold through a 15% to 20% drawdown without panic selling at the worst moment. Because here's what history teaches consistently. Forced technical selling in structurally tight markets creates opportunities, not endings. The 2011 margin-driven crash in silver was ultimately a buying opportunity for those with patience and capital. The 1980 collapse, though more severe, eventually led to stabilization and recovery. The pattern suggests that mechanical liquidation exhausts itself, and then fundamentals reassert control. The question is whether you're positioned to handle the volatility until that happens. The CME raised margins. The index rebalancing starts January 9th. The forced selling could push silver down 10% to 15% from current levels. And what you do in these next few days, whether you reduce, hold, or wait to add, will determine whether you navigate this technical pressure successfully or get caught in the cascade. The clock is running. The rebalancing is scheduled. And the silver market is about to show everyone exactly what happens when margin-driven liquidation meets index rebalancing meets structural supply tightness. This isn't a prediction of disaster or triumph. It's recognition of how markets clear when multiple forces converge. Welcome to January 2026.